On this episode of The Capitalist Investor, we are going to talk about how Ohio is moving to a new flat tax as opposed to the progressive income tax that we are most used to. Most people are going to say that this is just helping high-income earners. But what if I told you that this is a very impactful advantage for more sophisticated retirement planning?
Hey Tony, how are we doing today, man?
Doing good, man. Doing good. I'm in a good mood. Let's hit this.
Absolutely.
So we are talking about Ohio is moving to a new flat tax as opposed to the progressive tax that we've all been accustomed to over the many, many years. They're moving to a flat tax, 2.75%, virtually for everybody.
Yep.
Anybody over like $26,000 of income. But that's not happening until next year, 2026.
Right.
So there is a slight scale this year in 2025. So they're lowering the top bracket from 3.75 or 3.5 to 3.125.
Yep.
Like it's, I don't know why they just wiped the slate clean, but whatever. So Ohio is moving to a flat tax as opposed to a progressive. So most people are going to look at this like, great, it's just helping the high-income earners. And because not much changes from zero income to 100,000.
Right.
Because above 100, it right now 2.75 is like under 100 grand, and anyone over 100 grand of earned income and or just reported income is 3.5.
Right.
So this is, 75 bips, 0.75% is, the change coming up in 2026. And again, I've mentioned there's a slight differential this year. But this could be a very big deal for some, right? And we're going to talk about some of those advantages because now the tax is just predictable.
Right.
You don't have to worry about the sliding scale and figuring out averages and stuff like that. We just know what it is.
Yep.
So what's your take so far, Derek?
Well, it certainly helps me out when I'm sending out ACH outs for the clients.
Yeah, correct.
And I don't have to wonder if it's 2%, 3%, what should I be withholding? Should I do a calculation?
It's so funny you said that because as I was reading this, I'm like, man, I'm going to have to that's exactly what I'm going to do. I'm just everyone's got this, and I don't have to figure out we should maybe do 3 or 4 or what. I don't have to guess on what we need to do anymore. So that's great.
So yeah, number one, I thought it was a great topic because I think, I don't think, this was all part of all of that legislation that was surrounded by actually the Browns football stadium talk.
Okay.
And the unclaimed funds. Have you ever heard about those?
No.
That's apparently what's financing a big part of the stadium is unclaimed funds.
Huh.
So, but it's a good thing. So, essentially they're running a bit of a surplus. But I think for the everyday pre-retiree or retiree, it really just opens up potential for a lot more tax discussion, at least, and potentially some tax moves.
Yeah. So first thing is let's talk about some key points here. So predictability.
Yep.
We just kind of alluded to it. Better planning. It's easier just to plan around it. Mm-hmm. So that makes things great there. And obviously if you're making over 100 grand, you're getting, you're paying less tax.
Yep.
And that doesn't happen too often. But when it comes to more retirement planning, it can absolutely help lessen the blow slightly for just Roth conversions.
Right.
Right. And the discussion continues to happen with Roth conversions in clients because, over the last decade, the market has done extremely well. Mm-hmm. And there's points where I'm having discussions hey, Tony, RMDs are starting in a few years, and I actually have to take out more than I need. Yep. And that's a problem. Mm-hmm. So can we, nip it in the bud early? And that would be Roth conversions before RMDs start, right? And it's right now it's age 73, and starting in if you were born after 1960, RMDs actually start at 75. So your runway to do conversions when you retire could be nearly a decade.
Yep.
So these are things that we need to talk about, because we can have a whole show on the pros and cons, but primarily the pros for a Roth conversion. But that slight save, that 1% is extremely helpful, right? So that's kind of, the predictability is very, very important.
One thing I'll interject while you're getting your next thought. Just because we've had lots of conversations over the years now on the show about taxes. We were, kind of worried about the Democratic tax plan, tax increases, all that stuff as it relates to individuals, as it relates to, just the general economy and how that was going to work out. So it's a very important note to always talk about. Never base your entire financial plan on today's tax legislation.
Right.
It can always change. And I think I wasn't a huge Roth conversion guy before, but now that RMD has been pushed back to age 73 and like you just mentioned, 75 after 1960, that gives you such a great runway to do Roth conversions, and it's such a relatively easy and manageable estate planning tool as well.
Yeah, I mean, you're eliminating future RMDs in a Roth IRA for yourself, tax-free growth, but it's as the growth, it's all tax-free. It's fantastic, and it's tax deferred. And like you mentioned, it's a great legacy tool. So if you're going to pass anything on to the next generation, if that's one of your retirement goals, it's perfect, because they can let it, the way the rules are set up, they can let it cook in the account for 10 years and take it all out, and there's no taxes.
Yep.
If you give a traditional IRA to the next generation, I'm having conversation. I'm like, we should be very systematic about we need to start the distributions now, because you don't want to just have one big year of distributions, because you're going to get crushed with taxes. And usually when you pass on a accounts to the next generation, they're usually in their highest earning years. So it's not the time you want them to experience the tax.
For sure.
But anyway, again, Roth conversion, man, that's a whole show on itself. So Derek, the next key point is, this is obviously if you don't do Roth conversions, it's just going to put more money in your pocket. Specifically if you're, making over $100,000 of income, whether it's pensions and Social Security and distributions from your retirement accounts, it's just a lower tax, right? Here's a fun fact that I was talking with our CPA after the big beautiful bill was passed. And this is actually pretty important. It's a Roth. I know, if we're talking about Roth conversion, I'm going to slide this in here again. But taxes are going down on the state level, but they actually changed a little bit for us on the federal level. So if you are over age 65 on Social Security and making under $150,000, you now have a new standard deduction. If you are married filing jointly and making over $150,000, you have an additional $12,000 of deductions. So you can do one of two things. If you're okay with the tax, bubble you've been in the last, 8 years under the Trump's tax laws, the new additional $12,000 allows you to do one of two things. You can reap the benefits of a higher deduction. That means roughly maybe $1,500 per year that you are now in your pocket, right? At the bottom of your checking account is what I call it. Or you can say, hey, I was okay paying the taxes I was the last several years. I'm going to convert $12,000. So now you get to convert $12,000, still be in the same, the same tax lane, I'll call it, in the past years. Nothing really changes, but now you are creating a new account, a type of account to draw from, a tax-free bucket if you don't have a Roth. So again, what do you want to do, right? Do you want to convert, or do you just want to enjoy the money?
Yep. I actually have a client coming in tomorrow to have this discussion.
Great.
So they are basically right at that threshold I think they can do about a $5,000 Roth conversion and still stay under that 150,000.
Yeah.
So they basically get a free Roth conversion and then some. Or they've been making big Roth conversions as an estate planning tool. So yeah, we'll just have a talk and see what they want to do.
Yep.
But it is a this is the stuff that makes a difference in your overall plan. Just understanding the rules. And acting on them. So, that's what we're working on tomorrow with one of my clients. It's a good thing to take a look at it in your situation.
Yeah, I mean, you could be looking like, oh, whoop-de-doo, Derek, 12 grand. But like, when we build a financial plan and we got you living to 95,
yep,
and the runway could be 20 to 25 years, 30, whatever that number is, like, yeah, it is a big deal. It is a big difference.
Yep. 12 grand that lasts another 25 years with, compound interest. It makes a difference.
Correct. So, things to think about, right?
Yep.
So again, more money in your pocket. That's just obvious. And then, the last point would just be like timing the conversions and reallocation.
Yep.
So now's the time to upfront, load the Roths and take care, because this is actually another conversation I've been having with one of my more analytical clients, which I can appreciate as an engineer. I got to see the whole spreadsheet. I saw how it was strung out, over the course of his lifetime. And, you think he built it out to age 85, and that was his break even, right? So essentially what he is saying, he's like, I am old enough to remember in the 70s when the tax rates were a lot different than they are today.
Yep.
Like a lot higher. Mm-hmm. And he goes, we could have discussions on how our government spends money, all the debt load that we have, this deficit that we're running all the time. And he goes, I'm just going to pay it now because I just don't feel like taxes are really going to stay where they're at for much longer. We don't know if we can really afford it as a country. So he's going to convert it all within the next like 3 or 4 years. And a big chunk of money in there. I had to sit down, but I can't argue with him on the interpretation. And then I looked at his spreadsheet, and there's assumptions here and there, but he's okay with it because he goes like, I just feel like that's the thing with the Roth conversion. You have to have conviction of just not like, I don't want to pay the tax, or like it seems like a lot of money. Like you have to have multiple convictions. Are you doing it legacy? Are you doing it because you feel like taxes are going up? Does it help your financial plan? Right? Like there's all these things on how to do it. And plus he's got another bucket of money, a non-qualified account to pay the tax. That's the most efficient way to do it. It's not that you can't do it another way where you pay the tax out of the IRA, but it's just more efficient if you have cash to pay the tax.
Yeah, we were, during the election season, we were talking Roth conversions because, for the potential risk of higher taxes in the future. Even though that has subsided in the short term, that doesn't mean that's not still a long-term possibility.
Yep.
So prepaying your taxes as part of your overall strategy, I have no problem with whatsoever. It's prepaying the taxes and getting them out of the way. I think a lot of people don't realize that when they get their 401k statement or IRA statement in the mail. Like that's not all your money.
That's not all your money. Temporarily on your letterhead.
Exactly. Exactly.
So the one thing that I did is like, okay, how impactful is this flat tax for us, and how does it compare to like other states? So I just picked Florida. Everyone loves Florida, loves going there during snowbirding and all this, and they're known for their 0% state tax.
Yep.
So that made me kind of dig in. I'm like, okay, well maybe there's some other taxes that kind of exist to say, hey, maybe we are on par with a state like Florida. Mm-hmm. So I started like taking a look at sales tax in Ohio is 5.75, but if you live in Cuyahoga County, Cleveland area, right, you're paying like 8.
Yep.
Right. So then I went down into Florida, and there's zero income tax rate, but their sales tax is like 6 to 8, so like 8 to 8. So we're actually paying more in taxes So what would be the benefit of just not uprooting and moving to Florida if you want? And then you start kind of thinking about Florida in a whole, and the cost of living is extremely different.
Right.
And maybe not, I don't want to say extremely, but it's definitely different. Housing is more, utilities are higher. Insurance is definitely higher. I don't think a hurricane has came through and hit here in Ohio anytime. So you got like all of that hurricane insurance. You got properties that just won't be insured.
Right.
You got there rocking a 7-figure house, and it doesn't have insurance on it.
Yep.
I have a client like that, and he just loves the place. Hurricane demolished it and he rebuilt it.
Yep.
But that's a lot of money to refurbish the whole house. And then they have higher property tax.
Yep.
So the headline is like, well, other states are still better. Yeah, but a lot of people ask me when I go out of town, like, what do you love about Ohio? And I'm like, it's simple and it's cheap.
Yep.
It really is, right? It's just, I'm going to be anywhere in 30 minutes around here.
That's going to be one of my main points here. Obviously, the flat tax rate isn't really pushing me much over the edge, but it's a great place to live. Honestly, it really is. It's got low cost of living, it has reasonable taxes, it has a lot to do. Until the mayor screwed up the airport, it was one of the greatest, and it still is. But having the hub, the Continental hub in Cleveland, those were the days.
Yeah.
So it's harder to travel out of here now. But other than that, it's a very affordable place to live, and people only like clear cut arguments these days. Black, white, right or wrong, whatever. There's nuance to a lot of this stuff. And a more favorable tax rate is probably going to keep more people in Ohio full time than moving down to Florida.
That's the big thing, right? Like lowering the taxes, incentivizing people to stay here,
right,
or come here, right? And that's actually a very we talk a little more about like retirement planning and stuff like that, but like that's actually the key,
right?
Like, hey, we are now in. I was looking at it, we're like in the bottom third of state tax across the country. I mean, I think there's like, I don't know, 10, I look like call it 15 plus or minus states that don't have state tax, but we're like one of the lowest when you get out of the zero.
Yeah,
right?
it's the second lowest flat tax.
Is it? Okay.
Yeah, with when it goes down to the 275.
Awesome. Well,
yep.
So I mean, again, it's not. It is. For some of our listeners, it could be about retirement planning. It could just be about more money in your pocket. It could be about growth. Like lower taxes historically has stimulated growth.
Yep, for
right?
sure.
So like that's those are the three keys.
Yep.
So, all right. Well, fun fact on Ohio's new flat tax and what it means to you and how you can take advantage of it.
Yep, absolutely.
All right.
Well, good show. Something I didn't research a lot before we came up with this topic, so I thought it was very timely and important. So thanks everyone out there for listening. If you guys have any questions, comments, concerns, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.